get forward talking about MACD, the Moving Average Convergence and Divergence. Now, there's many technical indicators out there. MACD is one of the few that I use because I'm a price action trader. But indicators do just that. They're indicators. They're like the translators of the market. If you can't understand what price action is telling you, then an indicator might help you translate or interpret what price action is telling you. Now, MACD was developed in the late 70s by Gerald Appel. And it was developed primarily for the stock market because there was no online trading then. And the stock market was the biggest place that people traded. Well, they didn't trade, they invested. There were very few, there was no online trading because there was no computers back then. There was no internet. But as the online trading arena grew, traders started applying these known indicators to see if they would work with their trading. Well, MACD was one of the most popular, and is one of the most popular, Forex indicators and CFD trading indicators because it adjusts very quickly and very easily to fast-moving markets in small time frames. Now, MACD issues many different types of information or many different signals to us, not trading, but gives us pieces of information. Now, the MACD indicator is typically placed at the bottom of the trading chart in a separate window underneath the price. The Moving Average Convergence and Divergence is relatively an easy to use tool. However, it is crucial to understand it fully before attempting to trade just a signal. Too many traders hear, oh, MACD is easy. Just drop it on your chart, and whenever you get a crossover, buy or sell. That would, I mean, by the end of a first week, you probably have lost all your money and gone home saying these people are crazy. MACD is an excellent indicator, but you have to understand where its signals come from, how it's built and put together, so that you can interpret it properly to make intelligent trading decisions. So the concept behind MACD is pretty straightforward. Essentially, it calculates the difference between an instance 26-day and 12-day EMA. Of these two moving averages, they make up what's called the MACD line. So let's go over to a live chart and let me show you this on charts so that it's easier to understand. Okay, so the first thing we do, now believe me, you don't have to do anything. MACD is automatically put on your charts when you just click on the indicator under MACD. But you have to understand what makes it up because too many people just want to click on the indicator. They have no idea what makes up this thing. And if they don't understand what makes it up, you can't understand what its signals are really trying to tell you. So MACD consists of a 12-period moving average and a 26-period moving average. Now, why 12 and 26, you might ask me? Well, that's the way Gerald Appel developed it. You could try to customize it and make it a 14 and a 92 or a 12 and a 16, but then it's no longer MACD, then it's Barry's indicator or Billy's indicator. Gerald Appel developed it with a 12 and a 26 day or 12 and 26 period indicator. It works well with this, and it's been tested with this. How many tests he conducted, how he came up with this exactly, no idea. But the final formula started out using a 12 and a 26 period moving average. But moving averages are relatively simple tools. And if we were just to use a 12 and a 26 period moving average, we'd be using what we just call a moving average crossover strategy. And a moving average crossover strategy works for us, but it's not an advanced indicator. In our case, MACD just starts at that point, because what MACD does is it takes the difference between the 12 and the 26 period and starts building the MACD indicator. So the MACD indicator starts out with what's called the MACD line. This is the blue line I just put on the bottom of your chart. This is simply the difference between the 12 and the 26 period SMA, or the moving averages, the EMAs that are above. So we no longer need these. On our charts, because MACD is all below. So this line, this blue line down below, contains all the information that we had in the 12 and the 26 period on our chart. And what is this? This blue line is just the difference between the 12 and the 26. Now the blue line is centered on what we call a zero line. Now, when the 12 is larger than the 26 and you subtract the 26 from the 12, you always get a positive number. When they cross over the moving averages and subtract the 26, which is larger than the 12 at this point, you would get a negative. So when we have a number, the blue line going below the zero line, we know we have a negative number. Above, we have a positive number. If we're above the zero line, we know the 12 period moving average was larger than the 26. When we are below the zero line, we know the 26 period was larger than the 12, because now we subtracted a larger number from a smaller number and got a negative. And we simply plot those differences on this chart and get the blue line. But what happens right here at the zero line? The zero line tells us something significantly important about those two moving averages that we had above. Think about it. Maybe you can tell me what it is. Anytime the two moving averages are exactly the same, they would be zero. So that tells us that we're getting a crossover at that point. At the 0 point, we're getting a crossover. So if it crosses over and below, where we know that the 26 period moving average is getting larger than the 12. If it crosses below and over, we know the 12 period moving average is growing and getting larger than the 26. But we know at each one of these points, the two moving averages crossed over. But again, if we were to trade this, we're just trading a simple moving average crossover strategy. But that's just where MACD starts. MACD then adds the next line onto the chart, which is called the trigger line or the signal line. And that's the line I just dropped on your chart in orange. And actually, while we're here, let me make it a little bit darker for you so you can see it a little bit better. Just a little thicker. So the orange line is called the trigger or the signal line. The orange line is a 9-period EMA, which is exponential moving average, of the blue line. So what is it? It's the same calculations as above, and then it is smooth with a 9-period EMA, an exponential moving average. So now we're two derivatives away from price. But now what we look at is the crossovers. When the MACD line crosses over the signal line, we get a buy signal. When the MACD line crosses under, we get a sell signal. Now, keep in mind that when we say buy or sell signals, I'd like to take them and throw those words in the trash can. When they cross over, we get a potential alert that there might be a potential for buying, or an alert that there might be a potential for selling. Now, one of the biggest fallbacks of MACD is it is not telling you anything about price, and it's not telling you how far or how long or how many pips the buy or the sell opportunity might be there. So in other words, when you get a crossover here, when you get the crossover here, it's telling you that there is a sell opportunity. But if you notice on the charts, yes, price eased down and it fell right away, but not enough that you would have ever made any profit. You couldn't have gotten in the markets fast enough, and the dip at this point wasn't far enough for you to have made any profit. So it didn't give you a false signal. It just doesn't tell you whether it's a tradable signal. So you have to be very careful when using MACD, because it's only telling you that there's potential opportunities and telling you have to look elsewhere to analyze these. So to correct this a wee bit more, MACD also gives you what's called a histogram. So we have the MACD line and the MACD signal line. All potential opportunities. Now, to read these a little bit better, we use a histogram. Now, the histogram is simply a visual representation of the values of the MACD line and the MACD signal line, the orange and the blue line. And it's just the difference between those two. So when the MACD line, the histogram is right on the zero line, it's telling you we're right at exactly a crossover. We also see some of the momentum of the strength of the move in the bars going up or down. And we also see the depth of the move. So we can start to see overbought or oversold situations. And we get a more accurate depiction of the opportunity. So here we would have had a potential buy opportunity. But see, the market didn't go up there, but also MACD really didn't, it went above, but it really didn't do anything. Now, there's people like me who love MACD, but we don't need all of this information because we can see it all in the histogram. So for instance, I turn off my MACD and my MACD signal line, and then I'm only looking at the histogram. And the histogram visually gives you a much better representation of what price is doing as it moves along its journey. And we get to see the depth of the movement. We get to see overbought or oversold situations. And we could actually even see convergence or divergence when the MACD histogram starts moving in a different direction than price. And these are three of the stories that the MACD histogram gives us, or MACD gives us in general. So when we combine our MACD with more things like support and resistance and add volume to our charts, volume can help us interpret what MACD is trying to tell us, because as we see the crossover, we should also see a significant change in volume if it's giving us a valid signal. So the MACD is perhaps the best all-around study available. Indeed, this author considers the MACD to be the best signal oscillator available, and its value to learn its nuances inside and out. Other than the price trend itself, MACD is one of the most accurate probability, not profitability, probability signals. The new trader would be wise to concentrate on really learning the MACD and its histogram before moving on to other oscillators. Now, notice that the MACD here helped traders notice trend changes from a very early stage. You can easily see these trend shifts, especially using a histogram and using the zero line. Whenever the histogram, or the MACD signal line and trigger line cross each other, we should see a change, a prediction of a change in the trend. So keep in mind, MACD gives us three stories: convergence and divergence, crossovers, and overbought and oversold conditions. We can see all this easily visual by using the histogram. So the basic MACD trading rule is to sell when the MACD falls below its signal line. So remember the blue and the orange lines on the bottom, when they cross each other, when the MACD line falls below the signal line, it tells you to sell. When it crosses above, it tells you to buy. Okay, but remember, I said they were buy and sell alerts, not open and close a trade. The MACD also is useful as an overbought, oversold indicator. When the shorter moving average pulls away drastically or dramatically from the longer moving average, so we get a bigger separation between the two, we get overbought or oversold. Or in histograms, we can see that by the depth of the peaks and the valleys. And then lastly, we also see divergence. And it's when the MACD histogram or the MACD line is moving in a downward overall movement and price is moving in an upward overall movement, we see divergence. So an indicator that an end to the current trend may be near is when MACD diverges from its security. A bullish divergence occurs when the moving average convergence and divergence indicator is making new highs while prices fail to reach these new highs. A bearish divergence occurs when the MACD is making new lows while price fails to reach each new low. Both of these divergences are most significant when they occur at relatively overbought and oversold levels. So in other words, when we're seeing these overbought and oversold levels, and we're seeing these deep when we're seeing divergence, and we're seeing very high peaks and valleys in the histogram or in the signal itself, they become more significant. But the fact is, we're getting no information except we're getting some forward thinking or something to think about, because until we get a break and until we get a crossover, there's nothing we can do anyway. So keep in mind that the MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the actual price of the underlying security. And that's good, because the farther we get from price, the more reliable the indicators are. Because if we're using something very close to price, because keep in mind, every indicator out there only has 5 things it can use. Does anybody know what they are? Every indicator basically in the world uses the open, the close, the high, the low, or volume. That's it. Now you can twist those around any which way you want. The formulas that they're applied can be twisted. Some use just the open and the close. Some use just the high and the low. Some use all 4. Some use volume, some don't. But they all, that's everything we have is contained in those pieces of information. Every indicator. So it really just depends on then the formula that's applied to those indicators. Whether you use standard deviation, whether you're using these formulas like here. But the more reliable or the more steps removed away from price, the more you're going to see, because if they're all very close to price, all the indicators are going to basically give you the same thing. So our first derivative is the 12-day EMA and the 26-day EMA. The second derivative from price becomes the MACD line, which is the 12-day EMA minus the 26-day EMA. The third derivative is the MACD signal line. Remember the orange line that crossed over the blue line? That's the 9-day EMA of the MACD line. And the fourth derivative is the histogram, which is a depiction of the MACD less the MACD signal line. Oh, that's a lot to say, isn't it? The base of this indicator is the security price. It takes 4 steps to get from the actual price to the MACD histogram. So you want to talk about massaging data? That's it. While not necessarily a bad thing, charters should keep this in mind when analyzing the MACD histogram. It is an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of an underlying security. So whether you're using the MACD lines or you're using the histogram, they all give you the same piece of information. Like I said, the advantage to the histogram is it gives you a much better visual representation of what price is trying to tell you. And ultimately, what you're trying to do is interpret what price action is telling you on your charts. So like I said earlier, I'm a price action trader. I trade from support and resistance and chart patterns. That's it. And basically, I'm a triangle trader and support and resistance trader and price action. So when I'm looking at price and trying to interpret what price is telling me, I'm constantly looking at my support and resistance level, and I'm looking for some chart pattern. Now, there's a lot of times I'll get this chart pattern, I'll see my next support and resistance level, but I can't wrap my head around exactly what it's telling me, and that's when I will look at my indicator. You should never, my advice is you should never base your trading on indicators. Indicators are the interpreters of what price is trying to tell you. They're when you can't understand or it's not native, where you go to get the final piece of information. So keep in mind, it's become standard to plot a separate moving average alongside the MACD, which is used to create a clear signal for shifting momentum. That's the signal line. The signal line will help us see the shifts in the market. Combined with the MACD and the signal line and that zero line, that center line is ultimately important, because that center line tells you the shifts in the market, tells you the shift in momentum, and it also tells you the development or the weakness in the current trend. And the biggest disadvantage for using this indicator to generate trading signals is that a trader can get whipsawed in and out of a position several times. Now, as I showed you, and as I told you, the MACD does not tell you to buy or sell, and it doesn't tell you what risk you would have, doesn't tell you what potential target you would have, and it doesn't tell you exactly when. It gives you the indicator that you should buy or sell, but it's only giving you an alert. It's telling you or smacking you on the back of the head, and it's saying, hey trader, Here's a possible opportunity. Quickly do some analysis and determine if you can trade. So in other words, when I'm looking at my charts and I see a potential breakout of a triangle and I'm seeing it's close to a resistance level, a support level, and I'm seeing volume start to edge up as it breaks out the apex of the triangle, but I can't find, that's when I look at my MACD. I don't look at my MACD before because I'm looking for my final support. Or the other way, you're looking at your MACD and when it gives you an alert, you're then looking at the other and making a final decision. But MACD is not something you base your trade. I've seen, in fact, I have videos and presentations based on using MACD with RSI and stochastics to make a whole trading strategy. And I'm telling you, MACD works well with other indicators, but your strategy should always be based on price action, and your indicators should always be your interpreter or your indicators. So traders should be aware the whipsaw effect can be both severe in trending and range-bound markets because relatively small movements can cause an indicator to change directions quickly. The large number of false signals can result in a trader taking many losses. When commissions are factored into the equation, this strategy can become very expensive. Another MACD drawback is inability to make comparisons between different securities. Now, if you trade a limited amount of securities and you trade them often, you will be able to see how MACD works with that security. You can define your MACD. You could actually shift, if you wanted to shift your 9-day moving average to a 10 or 11 or 12 to see if you get better signals for that small group of securities. But you need to test them and analyze them. So the MACD indicator is one of the most popular tools in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crossovers of the signal line make it easier for traders to make sure they are trading in the direction of the current momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD. And this relatively simple indicator can quickly be incorporated into any short-term trading strategy. So momentum is critically important. Understanding what side of momentum you're on, because you should always be, we always say trade with the trend. You should be always trading where the momentum is, because trends will start to lose momentum before they peter out. So momentum in charting is like momentum in physics. You throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when that ball will stop climbing and change direction and descend. So just like in physics, momentum changes occur before the price of an asset changes. So thank you very much for joining us tonight. If you do have any questions, draw them into the window and someone from our financial analyst department will be glad to send you an answer. I hope you learned a little bit about MACD tonight. And as I said earlier, if you want to see a recorded version of this class, in about 24 hours, you can use the same link you used to come to the live class and you'll be able to see it recorded. Thank you very much and have a great trading week. And thank you for being part of the Alvexo family. Good night now.